Is Palantir a $1 trillion company? Is it undervalued? Is it a company we should consider to add in our portfolio? We're going to analyze this in today's deep dive. We're going to look at the historical performance. We want to see how well is this company growing both on a top line revenue basis as well as bottom line net income. We want to see the health of this company, their total cash versus their total debt. And we want to see how well are they performing over the last few years. Are there any companies that are better in this industry that we should consider? And as always, we'll look at the institutional ownership and understand why insiders are selling a lot of shares, as well as understanding if we should be worried about this. We'll also consider their metrics, their free cash flow, their sales growth, as well as a few others, and a few topics that we do want to discuss in today's episode with some latest news. Now, two things we're going to do, not just the valuation model getting to our intrinsic value, but we'll also consider what price will Palantir be trading at if this is a $1 trillion company. And as always, we're going to look at three different growth rates for this company, a low, medium, and high, to understand where this company is going with the valuation. Is it in fact overvalued, or is this a really strong undervalued buy that we should continue to add to our portfolio? So let's jump straight into the historical performance. Now we can see over the last year some very strong growth, up 188%. If we look at the year to date, it is also up 34%, outperforming the S&P 500. And when we look over the history of this company, we do see it hit some highs at around $36 in January 2021. It has come down, in fact, as low as around $7, and in fact slightly lower into the $6 at the back end of 2022. Now, it does currently trade at the upper end of the 52-week range with a forward PE of 70.32 and a market cap of around $50 billion. We also have both Seeking Alpha analysts as well as Wall Street considering this a hold now, so it will be interesting to see where our analysis takes us today. Now, a few things to note with this company. Recently, analysts did revise their price targets, talking about how they see this company is overvalued, and that did affect the share price. It did drop around 6%, although it did recover slightly. We also have some interesting news with a new partnership with Oracle as well, which is very strong. They have essentially teamed up, as we can see here. So this is going to be another contract that is added to the long list that Palantir are securing and increasing year on year. Now, in terms of the numbers, so we do like to look very quickly at the total revenue. 595 million reported in 2018, 2.2 billion in 2023. So we can see that growth year on year, very strong on a granular level. And when we do take a look at it at a graph, it is moving in the right direction. And this might surprise you, not all companies do have that consistent increases to their top line year on year. So that is a big positive. Another positive to note is they did make a profit. They went from negative 580, so a net loss, in fact, of 580 million, to a profit of 210 million their first year in December 2023. So it is a positive sign, and that is shown from the graph here, around 5 years of a net loss before finally turning a net profit. Now, in terms of the strength of this company, their total cash versus their total debt, it has increased from around 1.1 billion to around 3.7 billion in the latest year. And we can note as well their cash has also been increasing, which is a positive sign. But we always like to combine this with a total debt analysis numerically and directionally to understand the health of this company. And whilst it has increased from effectively nil in 2018, it is now sitting around 229 million, which means they do have more than enough cash to pay this off. And in fact, it has been decreasing as well. So another positive to note when we do see that total cash has been increasing. Now, in terms of comparing its performance to others in the application software industry, as you see, we have Atlassian Corporation, Autodesk, Dassault Systems, Roper Technologies, and Datadog, all very well-known companies. And we can, in fact, see Palantir has had the best return over the last year, up 188% by quite some margin as well. The next one being Datadog, ticker symbol DDOG, up 88%. And when we expand this over the last 3 years, we in actual fact see that Palantir is one of the lowest performing, and we can see negative 2% return. So do understand that past performance isn't always an indicator of the future performance, but it has gone through a bit of a rocky time. As we did mention earlier, the share price did go down to around the $6 level, but it has been as high into the high 30s. Now, in terms of looking at some brief growth metrics, we can see that their year-on-year growth very strong at 16.75%, above the sector median of 4.5%. Forward looking as well, 19.18%, above that 6.9% of the sector, and that is across the board. They are producing some very strong numbers, and we can see the gradings, B plus being their lowest rating, with others A plus and A minus. Now we do have a D negative here for their capital expenditure growth, negative 62%, especially when the market is showing the medium of 9.37, but that isn't one to really consider when we are looking at this type of company. Now, in terms of the profitability grades and some other metrics, again, a little bit of a mixed bag. Positive to note, their margins are improving, 80.62%, well above the sector medium of 48.5%. The same can be said for the EBIT margin, above that 4.88%, although they do lack slightly when looking at the earnings before interest, tax, depreciation, and amortization. What I do quite like seeing with companies is their bottom line, so their net income margin, 9.43%, well above that sector median. So positive in terms of a lot of their metrics. This is a company that is not just increasing their top line revenue, but also increasing their bottom line margin as well as their gross margins. Current institutional ownership, then, it does sit at 46%. We see 613 million worth of sales by these institutions over the last 12 months, with a significant amount more of buys, 7.5 billion, and we can see during the same period. When we look at the more recent quarter in 2024, 9.25 million versus 129,000 worth of sales. So institutions over the last 12 months and in the more recent quarter are buying a lot more shares of Palantir than they are selling. Now, conversely, when we do look at insiders, a very high insider ownership, in fact, of 14%, a lot of insider selling, and we see from around 11 insiders, 280 million worth of shares. Q1 being the largest portion at 184 million. And when we do take a look at this data, we can quite see here a lot of selling. In fact, one of the largest, the 12th of March, by the director Peter Thiel, selling over 7 million worth of shares. And you can argue that share price is higher than the current price, 174 million shares, as we just pointed out. What I would say, insider selling, it isn't a bearish signal, but when you are seeing large amounts of sales by insiders, it does give you something to consider and possibly use when you are looking at your investment thesis for stocks. But I wouldn't say straight away it is a bearish signal. You do need to take a look at other aspects of this company. Now, just to let you know, we have released our latest free weekly article. If you do want to gain access completely free, do click on that pinned comment below. And we are running through 10 undervalued dividend stocks based on dividend yield theory that you should consider for your portfolio. If you want to see other stocks or other essential articles, all completely free, instant access, do click on that pinned comment below. So in terms of the financial metrics, what we like to see when looking at the free cash flow per share, and remember, earnings, we do ignore it, but you do have access to it on screen. It is just susceptible to manipulation by management through accounting. What we know on the free cash flow side here is that whilst it has been negative, it has been increasing and continues to increase into FY24 to around 37 cents expected. Sales growth as well, whilst it was increasing quite rapidly, we do note it is starting to slow down slightly, but even at 17%, still very healthy in the double digits. And from their latest investor presentation, the double-digit increases to their top line is expected to continue. Total sales as well, it has increased from 600 million in 2018 to 2.23 billion. And we can see, unfortunately, they would have diluted your position as a shareholder over the last few years, increasing that share count. So do bear that in mind. ROIC, now because they have finally made a profit in 2023, we do see a positive number. But what is nice to note, it has improving over the last few years. 2024, 2025, hopefully we will see some very strong return on invested capital. And that essentially shows us how effective management are at allocating their capital. Operating margin also, again, no surprise given they made a loss, finally turned positive in 2023. But what is nice to note is the free cash flow margin has been very, very strong over the last 3 years. Net debt to EBITDA, no surprise here, as we did mention, this is essentially the earnings before interest, tax, depreciation, amortization, with these numbers showing us the number of years it would take the company to pay off all of their debt net of cash on hand. It wouldn't even take them 1 day over the last 4 years, or even 1 day in FY24, signaling they have a very strong balance sheet. So let's get into the valuation. And as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically, we use a few different models to get to our intrinsic value. We have Graham's valuation, multiples, DCF, and the DDM model. However, for today's episode of Palantir, the only one that is relevant is the discounted cash flow model. We have the free cash flow year on year. We do see a very mixed average growth rate given the fact that it has gone from positive to negative a few times. Now, forward looking, we've gone for 3 different rates: low, medium, and high. What we have selected today is the medium rate at around 25%. And what we can see here is that based on the discounted rate, we get the present value of future free cash flows and terminal value, which we add with the cash, subtract with total debt, get to the equity value, divide by shares outstanding, and we can see here an undervaluation signal with an intrinsic value of just over $30. Now, for those that believe that that is too high, we can go down to around 20%. At a 20% growth rate, we do see it isn't too far off, so we believe it's roughly fairly valued at a 20% forward-looking increase to their free cash flow. And as we can see here, on a 20% growth rate, we see upside of negative 3%, 25% upside of 33%, and for those who believe that even 25% is too conservative, at 30% we do see essentially an intrinsic value of $42, and this does indicate a high 30% growth rate, value of $42, and upside of 83%. Now we're going to take through to the end or 25% estimated medium growth rate to get an intrinsic value of $30.62. Now, typically the intrinsic value is the average of the models, but for today's episode, as we are just using one model, it is essentially the discounted cash flow valuation. So an intrinsic value of $30.62 with the current price trading of $23, we use a margin of safety of 10%, and we use that if we believe it meets the 3 criteria of a wide moat, strong financial metrics, and good forward-looking data. Now we can see at 10%, it does look to be a buy up to $27.56. At 20%, around $24.50. 25%, pretty much bang on the current value. So with that intrinsic value, if you believe the discounted cash flow will increase by around 25% year on year, then we do see around a 25% margin of safety. Now, in terms of Wall Street and what they estimate, well, they believe the share price will go up to around $30 over the next 12 months, with upside of 31% from this point, just over a 1-year period. Now, many analysts have different price forecasts. We have gone for an average of the majority, and that is where we are getting this number from. Now, one thing we want to point out, if we believe that this is a $1 trillion company, this is the metrics and the numbers that we would have. We would believe that the price would go up to $460, which is effectively 20 times the current value. But bear in mind, for this to be a $1 trillion company, their free cash flow would have to increase rapidly year on year over the next foreseeable future. What this would mean then, the growth rate would need to be around 72%. And when we can see that, that does look like a very high task for this company. But again, different people have different valuations, have different beliefs, different investment theses. But for today's episode, we have gone for a more conservative outlook at 25%. As we indicated, this 25% gives a margin of safety of 25%, with Wall Street allocating 31% upside as their beliefs. As always though, do let us know your thoughts in the comments below. Is Palantir one that you're adding to your portfolio? Is it one that you added at the lows, continue to add, and see it has some very, very strong movement over the next few years? Or similar to the recent analyst who did downgrade this company, do you believe that this in fact is overvalued now, sitting around the $23 mark? As always, don't forget you can grab a copy of this valuation model if you want to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or those on your watch list by clicking on that pinned comment below. Smash that like button if you did enjoy today's episode. Hit that subscribe and bell button so you are continually notified of these videos. And as always, we'll see you all on the next one.